My name is Chuck Whitman, and I build great traders that lead great lives. Traders I've trained have generated in excess of $1 billion in trading revenue and are found in some of the largest proprietary trading firms and hedge funds in the United States. Today, we're going to talk about butterflies. No, not the insect, the option strategy. And we're going to talk about butterflies in a different context. We're going to talk about how you use butterflies to set up really big winning trades. Now, I talked about this a little bit last week. We talked about how hedge funds outsmart algos by being able to put on massive positions using butterflies that then become somewhat of a binary trade that they do not have to get out if they're wrong because they just risk the premium that they paid for the butterfly. But if the butterfly works, they can make a massive amount of money. And in putting these large butterflies on, they don't have to deal with the algos chasing them and racing them as much as they normally would. They don't have to deal with them going in, and they never have to deal with them getting out because if it doesn't work, the spread just goes out worthless. Well, we're going to expand upon that today. We're going to talk about how you can use butterflies to be able to generate really big profits. Now, when we start off, one of the things I want to say is that most people think of using butterflies in a completely wrong context. Most traders look at butterflies, and particularly iron butterflies or iron condors, which would be a discussion for another Trader Tip Tuesday, but they look at butterflies or iron butterflies as a way of bracketing a market that's not moving and to be able to collect theta when the market doesn't move, to be able to collect time decay when the market doesn't move. Essentially, what they're doing is they're shorting an at-the-money straddle, and they're protecting themselves by buying wings. And that creates the long fly or the iron butterfly. That's fine, but that's a mediocre game. We're not here to play mediocre games, and we're not here to get mediocre results. We're here to trade in a very different way. We're here to trade in a way that we always know our risk, so we can always trade from a position of strength. And we're here to trade in a way that when we get it right, we make way, way more than what we lose when we get it wrong. This is the secret to trading, being able to generate large R-winning trades, or what we call jackpots. Butterflies are one of the best ways to generate jackpots. So we're going to talk about this a little bit today. When we look at the characteristics of long butterflies usually realize their value at expiration. They usually realize their value in the last 2 weeks, even the last couple days, even the last couple hours. So if we put on a butterfly and we rally too soon, it won't make much money. But if you can expire near the body, long butterflies have amazing reward to risk ratios. So what we're going to do different is we're not going to put on a butterfly to bracket the current price action. No, we're going to use butterflies to target a price, to target a path. This is one of the things that we talk about. We want to understand where the market can go and how we think it will go there. If we think the market has a chance to meander and work its way to that price slowly, then butterflies can be a home run. So examples of this, in indexes when we rally, in stocks when we rally, you tend to get this grinding, drifting behavior where you'll drift into the strike. And that is the perfect scenario. So we want to make sure that we think the market can go there somewhat slowly, where we're going to glide into our short and expire there. Now, if we can do this, we can generate some phenomenal reward to risk ratios. Like a long vertical spread, butterflies, we want to buy butterflies when the legs are highly correlated, and then they'll profit when the correlation between the legs breaks down. And essentially, one leg will be worth something, and the rest of them will be worth nothing. That's when the value explodes in the butterfly. When we put a butterfly on, we can work to scale out of it as the butterfly is working. This is one of the ways that we can manage our equity curve. And they can get hairy around expiration. So we want to be comfortable managing our expiration risk. But if we use them to target a specific price at a specific time, this creates a scenario where you can hit it and you can win big. So let's look at an example. We're going to look at an example of Netflix. So recently, Netflix had a breakout up. It had this big gap off of earnings. And then when it started to break out of this range, we went long. Now, we went long not just by buying stock, but we actually targeted a 1060, 1190, 1320 butterfly. So, and we're looking at this over essentially the next 3 months. So if Netflix has a rally to 1190 between now and the April expiration, let's look at what the risk reward looks like on this butterfly. Able to buy the butterfly where we buy the 1060 call, sell 2 of the 1190 calls, and buy 1 of the 1320 calls in April. And we were able to buy this for $21.59. Now, we have a risk point where if the market trades below that level, I'll show you that risk point is essentially below this low on earnings. If it trades back down below this low, we're going to get out. We estimate that we're risking half the premium. So we pay $21.59. Half that premium is $10.80. So we're essentially risking $10.79 or $1,079 per butterfly. So with $1 million account, risking 1% of our account, we're able to buy 9 of these butterflies. Now, the target on the butterfly is 130. So if we go to 1190 at expiration, the butterfly will be worth 130. So we'll make 130 minus what we paid, 21.59, but we're only risking half of that, risking 10.79. So this gives us an R of 10.04, 10R. And you can see to buy this butterfly, we only have to outlay $19,000 to potentially be long 900 shares of Netflix. So this has a really good reward to risk profile. These are the kind of trades that we're looking at. Now, this one's a little longer dated, but we could find other ones that we put on now that we expect to expire in a month. That way, that relationship between those strikes is still valid when we put it on. But as we move into expiration and the trade works, those relationships start to fall apart. And the options in the butterfly are either worth something or they're worth nothing. Now, the downside of a butterfly is that you could go all the way through it and out the other side and you could lose your money. So you could be really, really right and lose. But you'll see that there's other techniques that we have that can prevent that from happening. And you can see that it does create a strategy that is low risk. You know what your risk is at any given point and has potentially really big R's. The one we saw there, it was a 10R. But there are butterflies that you can construct that pay 20, 30, 50 R if they hit. It's definitely worth looking at these. This is a different way to put the trade on and not have to worry about getting stopped out or chopped out. Just letting it work or it doesn't work and you're fine. So what day is it? That's right, it's Tuesday. And it's not just any Tuesday. It's Trader Tip Tuesday, where I come to you with tips like today. Buying butterflies for limited risk, but big reward to help you take your performance to an elite level. I'll see you next Tuesday.